Good morning, afternoon, everyone. Here we are at Process Warriors, our favorite show, actually. Gives us an opportunity to educate everyone about all the things that you didn't know we could do.
That's right.
So, anyway, so we're looking forward to this show. We've got a lot to cover as usual, probably more than we can, which is, I guess, as Mitch always says, it's a good idea, I guess, that we have more than we can cover in a show. So.
Yeah, my days in Boy Scouts taught me to be prepared, so it's better to be over-prepared than under-prepared.
Yeah, I never made the Eagle Scout. I think just never made that. Too much of it. Go ahead.
Made it to life, but never Eagle. So.
There you go. So anyway, just to kick off, we're going to pick up where we do our best to pick up where we left off last time and talking about just utilizing the system and understanding orders and all kinds of different issues. We had a ton of orders, as you know, for yesterday. Markets seem fairly flat. I'm actually, just a side note, is I'm thrilled that they let us in so nicely.
Yeah.
It was a nice day from a mutual fund standpoint. There were a lot of mutual funds, and I think we pretty much closed flat, down a little bit, up a little bit on all the mutual funds. So it was like perfect day for a big major entry. So it wasn't like an explosion where the market was just taking off and we're dealing with all that stuff. So anyway, that was good. I was actually, and now it's starting to see some positive movement on the upside today and continuing this historic trek that we're on. I don't know, we're going to have to look at how many days there was in this rally, maybe, day 1422 or something like that. Anyway, on to Process Warriors. Mitch, why don't you go ahead and kind of set up where we're going to go today a little bit?
Sure. Well, where we left off last week was just talking about the individual research side of things when it comes to the 2.0 system. So we're going to wrap up a few more points within 2.0 specifically. Then we're going to jump over to Portfolio Expert. We have a lot of people using Portfolio Expert, especially those of you that are watching Process Warriors on a regular basis. So we've spent a good fair amount of time within 2.0, and that's because that's where most people use. But now it's I think appropriate to jump over to Portfolio Expert because that's where there's a lot of different tools available to you to either monitor securities, more dynamic queries and watch list, and also just do a pretty general introduction to it as well. We get some questions on it from time to time, so we're going to cover a few of the basics within there as well. But this is all, again, circling around that context of research. The reason that we knew that there was such a large shift within the database this week is because we knew where to look. And so what we want to do is be able to provide you with that same amount of transparency because we're using the same tools that you guys have available to you to be able to have this information. And so we just want to show you where that's at, how to find it, so you guys can make sure you're getting more out of it than probably what you're using right now.
Yeah, and I told Mitch, I said, I'm looking forward to the Portfolio Expert section because I'm going to learn a lot. Typical, I'm not as a power user on Expert, so maybe over the next several days / weeks, whatever it takes for us to, as we dig into that, to be very educational for myself as well. I ended up running the business. Used to be I did everything, including all the janitor duties, and now life has changed a lot. So I'm still kind of stuck in my 2.0 rut, which works fine for me and it works fine for everybody. So but there are a lot of different features and things, especially export imports, all kinds of different elements that are in Expert that aren't in 2.0. So it's just a combination of the two of them makes a lot of sense anyway. So
one of the things, we're going to skip through some of these slides because this is sort of a recap from last time. Again, we're talking about research. And in the last video, we talked about looking at the system from a high-level view, looking at the overview section within the research side of the site. And that gives you the top-down view of the system. And what that did is that provided us with that look of the all the activity within the system. We showed you yesterday as well on Market Thunder, as well as in the last broadcast of Process Warriors, a way to look at the all stats page and see the entire orders within the system, as well as how much of that's 1.2 versus 3.2, and then also what the expected duration and profit is from this high-level view of it. So if you haven't watched that, again, take a look at that, review it, and then come back to this video once you've seen it after we stream live, and you can watch it at your own convenience as well. We also talked about digging down to the individual security and looking at the research side of things, seeing where we're currently invested as far as what the current position is. We also mentioned trade, the trend phase. One of the other things that we did discuss was just something as simple as changing the trade systems. We'll touch upon that when we jump over to the 2.0 system in a minute. It's pretty straightforward, but there's some people that don't know that that's there, so I just want to highlight that to you as well, and then we'll pick up from there. And the other thing that we're going to be discussing is just a way to review the data. We've pulled up some of these points historically in some of the other videos, but we're just going to really call your attention to how to validate that the data is accurate, especially when tickers change. We may have a history of an old ticker where it gets picked up with a new ticker in its place. And so I just want to show you ways to check for that so you can see that you're looking at the right data and what to do in that event. And then from there, we'll also talk about the trade profile of it. So at this point, Bob, do you want to jump over to the 2.0 system, and we'll pick up, I think we were looking at Apple last time, so we'll go ahead and take a look at that.
Okay. Yeah,
and
no problem.
We'll dig into a few more stats in this, and we'll go from there.
All right. There we go. Looks like we're on the wiki page. Is that where you
Yeah,
want
we're
to
on
be?
the wiki, and I'll leave that pulled up. 'Cause we're
That's
gonna
something
use
we should probably go through because there's just so much information there.
Yeah, I mean that's an encyclopedia in and of itself when it comes to the amount of information. in
Yeah,
it.
Chris Martin put a lot of good work into that thing. He did a
did.
great job on that.
So as you see already, we have the 2.0 system pulled up. I just clicked on research so we could put in our ticker of choice. We're going to go ahead and put in Apple, and we'll do a search on this. As we discussed before.
Go now.
All right. Let's see. I think we got it going now. The joys of operating without a net, right?
Yeah.
So, you'll see this from time to time that when you pull up a security that it'll default to either 3.2 or 1.2 on the trade system. This is really basic, but I just want to make sure that you know that this is here. You can actually jump between all four of the trade systems that we have in place. So you can look at the data in terms of the 1.2 or the 3.2 context, and then whether it's weekly or on a daily basis. Bob, as far as the daily versus weekly, when is it appropriate to look at daily and when is it appropriate to look at weekly?
I don't know.
That's sort of a loaded question, I know.
Yeah, no, I always felt like daily's mostly entertainment anyway. It's more getting a feel for maybe what the short-term trends are doing, although we have seen some very good uses for the daily models with that, as in Global Equity 4 and some of the other stuff that we've done. So can they be used effectively? Yeah. The thing that for a lot of practices, it really depends on the level, I think, of staffing, and from an administrative standpoint, if you have the ability, to do orders anytime during the week. So if you come in tomorrow morning, all of a sudden there's a bunch of orders because you have a daily model in there. You've got to execute these things, especially on the daily model, because a typical holding period is now only 45 to 60 days compared to 200 and some days. So the trade execution becomes even more critical in capturing whatever the trade is going to have available to it from a statistical standpoint. So you really need to be on those things. So I've seen folks put in, we have an optimization box that'll just figure out what's the best of everything. You can run it that way, but for the most part, it's going to come up weekly that way anyway. But there are times when daily symbols will show up.
Yep.
Most of the time, it's because of maybe maybe a volatility issue with that particular symbol. But probably 90% of the time, you're going to get a weekly symbol for that kind of stuff.
Yeah, and the daily is just going to be, as you mentioned, it's going to be very active, with that typical holding period of only about 45 days compared to, what did we see the other day, around 200 or so when it comes to weekly?
It's around between 185 and about 220 in a range as far as that stuff goes. So, that's pretty much, the general range. So you got, basically there's about 220 days in a year. So you've got about a 1 year holding for the most part. So people always worry about it coming into VPM whether it's trading all the time. The answer is no. It's approximately maybe one and a half trades per year is probably the average if you went over a 10-year period on most of these things here. So
yeah, and it's funny. Last week I was talking with an advisor. I stopped by his office. He didn't get a chance to see the Market Thunder broadcast that we had last week, but he referenced the fact of selling at, let's say, $10 and then buying it a couple weeks later at $10.20 or something like that. And clients don't like to see that. And of course, it's if you happen to be using one of the more active trade systems like the daily series of trade systems, you're just going to see a lot more activity, and it's more likely that you're going to see something like that just because you're capturing these short-term trends of it. And of course, that provided us with a good conversation about proper expectations within the system.
And not only that, it brings me back to my favorite line for years: the dots aren't connected.
Right.
So they're just new trades, they're new probabilities, or new everything gets generated when that happens. And the difference is where I came from, the developer of this product and the process, from where most of you came from, buy and hold. I always thought that was a joke, that you actually bought and held something. I thought most of the stuff that I started with was derivatives. So if you bought and hold it, it expired and you lost all your money. So, or you got delivery on some product or something. So
whether you wanted it or not.
Yeah, I was a commodity guy. So we never had the option of buying and holding. You could roll over, but you couldn't buy and hold. And the same thing with the options world. I spent a fair amount of time in, but the realities are these markets do go up and down. The other reality is you can time them to a large degree. Markets are mostly predictable most of the time, not all the time, most of the time. And that's those probabilities are what we're playing into. And when you look at the VPM models, that's what you can get. So having said that, just I have to keep going down this trail, is that means that some trades are better than others. The trade location sometimes is better than other locations. It has to do with the setup. There's about 6 different basic setups on the buy side. There's about 4 sell scenarios that come out. But the bottom line is that's how the system works. So each market is different, each stock is different, each trade is different, and the characteristics and the circumstances around volatility and everything that goes around are dynamic in themselves. So you're applying what VPM is an expert system, which means it's hard-coded. It's just like robotics. It's just like if you went to Ford Motor and went to the assembly line. Those are robotics that are making all those welding spots. You move something in place, it knows exactly what to do. That's what VPM does. It looks for a certain setup all the time. It doesn't learn. It doesn't know how to learn. It only knows what it was taught in the first place. And so it does what it does. And those characteristics then I spent many years, and when I was starting to utilize this system, pretty scary, folks. We're talking 22 years ago that I put this into logic. And it's more years than I want to admit when I actually developed the strategies. But the bottom line is, I decided long ago is to understand the characteristics of the models and trying to fix the model. So you probably hear, if you guys have done any derivatives with the commodity futures guys, these guys are talking about how the markets change and they update and tweak their models. No. Understand your models is much better, because sometimes that little tweak leaves so many good trades in the background that you just can't even believe it. I when I was developing the system, the just by making a couple little tweaks by a couple points on what the values had to be, greater than, less than, whatever, made a tremendous difference in the back test. So I felt it was much better to do the ER ratios, understand the general conditions, how it normally acts. That's why we have all the stats that we have. It's much better to understand that than trying to fix it so you're always what's called out of sample. So I have no idea what it's going to do in the future. I fix it for the last trade, and that's pretty much how the ETF world works. Every time there's a big crisis, a slew of ETFs come out to fix what just happened, and then that doesn't happen again. They did it in 02, 03, they did it in 08, 09, and they'll do it in the next one as well. But anyway, just to get off on a little bit of a track there, those are important things, I think, to understand the characteristics. So got to be careful you asked me there, Mitch, because I'm not sure I even answered the daily weekly thing, but that really has to do with volatility. Just to summarize this, has a lot to do with volatility. The type of things that you're looking to do and how you want your practice to run is important as well, because sometimes the give up is big. In the case of like Global Equity 4, there's not that many trades that happen during the week. There are some, but there are a handful of trades, not even in a year. There's one or two trades that will happen midweek. So if you're able to handle that from a logistics standpoint internally, then that's a big deal. Then you can go forward from that way.
Yeah, and we'll show you in a little bit how you can actually verify and see what the trade activity is like, especially in the context of a portfolio when it comes to using the daily trade systems. Now, it wouldn't be right for me to go 1 week without mentioning our favorite four-letter word, data.
It wouldn't be prudent, right?
It wouldn't be prudent, right? But I just want to show you real quick. Whenever you look at a new security, it's important when we start to go into the stats that we're going to start discussing now, that you take a look, make sure you're looking at the right data. And I'm going to show you an example of data that looks correct, as well as data that I intentionally left in the system once I found out that it stopped trading under one ticker and started trading as a different company, or a different ETF in this case, years later, just because I want to show you what this looks like. So if you happen to identify it, you can alert us and we can get it cleaned up. We haven't had a chance to really discuss this on the broadcast. I've discussed this one-on-one with a couple of different advisors over the years, but this is a great opportunity for us to do that. In the case of Apple, I clicked on that Q button. We've done this before where we looked at the data on it. We click graph data. And what this will do is it'll show you the entire span of data that we have within the system. And this looks pretty good. We can see that there's no gaps, there's no straight lines that appear within the securities. And you can see right now, this because we have so much data on Apple, because it's such an old company. You can see it goes back to the 80s here. It's getting abbreviated here at 2009. We can adjust this time span and pick it up back in 2009 here. And view the data going forward.
Most people don't know this. They think that if you'd have bought Apple in 80 instead of Microsoft in 84, you'd be better off. And the answer is you wouldn't be. Microsoft did much better from 84 to current than Apple did from 80 to, because Apple was a dead stock for 15 years.
Oh yeah, I mean, I remember
almost went bankrupt in '99.
Back in 2000, where people were beginning to write it off right before the iPod came out.
Yeah, I mean, the thing was almost bankrupt when Steve gave back. So he saved the day for sure for those guys.
That's right. So as you see, I changed the date range. We're looking at the rest of the data here on Apple. So you can see this looks just like you would see it any other place when you pull up the raw data. I'm going to quickly jump over to Portfolio Expert.
Are you Are you? Oh, you did get
really
it.
Quick.
Yeah, you got it going. I thought he didn't have it running yet. So
no, we did have it open.
Okay, good.
What I'm going to do is I'm actually going to pull up oil. We've talked about this a couple different times elsewhere, and we've pulled it up in 2.0. I noticed a little while back. So here's the 10-year chart. Everything looks hunky-dory, if you will, on it. If you look at all on it, though, you see that we have this gap right here from 2001 till, 2006, where you see it's this gap of data. So if I was to load this in a security, or if I was looking at the stats on it, one of the things that I always do, especially in Portfolio Expert, is I look at the full range data just to make sure that all the stats that I'm about ready to dig into are valid. So in this case, we see that we have some prior trade history when oil was trading under a different ticker. So after today's broadcast, I'll get this data cleaned up now that we have record of it for the broadcast. But I didn't want to get it cleaned up until I could show you folks what this looks like. So in the event that you've seen this either within 2.0 or PX, Portfolio Expert, you can let us know. We'll get the data cleaned up. We have our own ways of looking for this stuff on our own from an administrative level. But just in the event that you happen to catch something, especially if it's an IPO where it just starts trading up again as a new ticker and we happen to not catch it, just shoot us an email at support@VPM Partners. And the reason why this is important, it's not so much that the orders after this date are not valid. What the issue is the stats that we're looking at, like things like the ER ratio, as well as the trade history, that's been manipulated by this prior trade history. So again, the data going forward is still fine. It's the data prior to this that we want to get pulled from the system so that we're looking at all the stats just around the security as it's been trading under, whether it's an ETF or a mutual fund or a security. So that's just a little note. We haven't had a chance to discuss it, but now we got it covered. I'll get this cleaned up. So let's jump back over to 2.0, and we're going to go over to Model Results Overview. And as this page loads up, we mentioned last time about the ER ratio, and I know we got into a little bit of conversation as to whether or not you should stick to the solid level of 100 on it. And I agree with Bob that there are some occasions where you'll take a look at a stock, and if you know that from some sort of fundamental basis or a screening basis that maybe we're now entering into a new phase of a particular let's say category or mutual fund or ETF or security where something has shifted within that space, that it might be wise to go ahead and use this security even if it has an ER less than 100. But we really haven't mentioned up until now how we calculate the ER ratio. So Bob, do you want to tell us a little bit of the story about how the ER ratio came around and sort of
the real story?
The abridged story. How about that?
The real story, anyway. Yeah, actually, my history goes back to a predecessor company called AIQ that I used to work for. I actually tried to buy the company back in 1992 with another partner. Anyway, they had an ER ratio, and we actually built when we started MarketMind, which is soon to be revived, and TradeStation, and we're going to be offering that pretty soon, pretty close to finishing that project. But anyway, we did it basically to piss off the old owner of the other company that in the 11th hour decided to back out of the deal for us to buy that company. And hindsight being 2020, it was all good. But the ER ratio, actually, what came out of it, it made us think about it. What they were doing with it was not as valid as what we did with it, and it had everything to do in the end with having a quick snapshot, a number you could look at and say, this model does pretty good on this symbol. And when you have 18,300 symbols, you need a quick shot. And the one thing I think we can do when we get back in Expert, we can sort a lot of ER stuff, and there's things that's sortable, I think, in some of these lists we can do in when we start building queries and things of that sort. There's some quite a bit of power at that level. So, but anyway, yeah. So did I answer your question? I guess so. Yeah. So
what's the mathematic? Now that we know the backstory.
Okay. So here was the goal, as I wanted to have a standard that would be a good model. So we figured that you're never going to be 50% of the time. You're going to be, if you were right 50% of the time, you made $2 for every dollar that you lost. You would be making $10 on the 5 trades you won. You lose $5, you're $5 ahead. And it came out of my trading activities. I realized you're going to do multiple transactions, and what you had to do is make sure to win in the end of the day, you had to be able to make more on, it's the old, hold them and let them run and cut your losses short. So you needed to look at all of your trades and see how well you did that on a ratio basis. So that was the number one. So if you're okay, I'm 50% of the time right, I make $2 and I lose 1. So we took whatever the percent of the the accuracy. So let's say I was only 40% right, and the standard was we had to be at that standard of that 2 to 1 at 50%, which equals 100. If you take and multiply that out, you get 100. So you take that ratio 2.0 times the percent right, and you're going to get 100. So now if you're 40% right, you got to have a 2.5 ratio. And some of the best stuff out there is, maybe 30% of the time it's right, but it's making $6 and $7 versus the $1 you're losing. So the fact that you lost 7 trades out of 10, it's the old story of the baseball player ready to go to Hall of Fame by striking out 7 times every time you walk up. So a 300 batting average gets you in the Hall of Fame, and it's a perspective that you have to have when you're going to be really good at something that you get a lot of swings. A baseball analogy is a really good one, because you get to bat a lot in your baseball career, and you're rated by how many times you're able to get the ball over the second baseman's head or further, right? So that's really what it comes down to.